the 3 questions, what's an investment for, and 3 questions, why, what, and how, and then you can spend most of your time on the what, cash, bonds, DC cuts eyes, stocks, bucks, and alternatives. That really is the question. You're just fleshing that out. If I were you, I'd already have your answer written through Convexity already typed up and ready to go, so that you can start adding the other stuff. A lot of students is like, hey, I'll worry about it 2 hours before the exam. That's fine if you want low scores. There is the perk that if you do well in my class, I become an advocate for you for jobs. That's not always bad to have. So I, but if you don't do well in the class, then don't come asking me for job references, because it may not play out very well. Not that I'm trying to bribe you to do well. All right, so we got into credit this last time. We talked about the credit ratings, and the definitions are in the notes. AAA, only 2 AAA left. It looks like Microsoft and Johnson & Johnson, and Microsoft doesn't need debt. They have more cash than they have in debt, so they could pay off all their debt right now if they wanted to. AA is very, very, very strong. There aren't really that many AA left. There's quite a few single A left, but those are the highest quality bonds. They have the narrowest spread. I put governments and sovereigns separately. They are rated. The U.S. government's debt is rated, but we tend to think of the U.S. government debt as the safest thing out there, even though they're actually rated lower than Microsoft, because Microsoft is AAA, and the federal government actually got downgraded AA+ by S&P when the government. So S&P and Moody's both, but S&P talks about the ability to pay debt, and they added a new word, the willingness to pay debt, and that's the reason they downgraded the U.S. government. So of course they can pay their debt. They can print money. They have no trouble paying their debt. But if Congress is talking about actually hitting the type, that debt limit, and not paying off the debt, then obviously we've got to downgrade them if they're actually threatening not to pay their debt. So that was why they downgraded. The interesting thing is Treasuries rallied after they got downgraded. So actually you would think you downgrade a bond, its price would fall, but Treasuries actually went up in price. So these have the narrowest spread. You don't get paid much for these. Over governments, you get paid nothing, because governments are the risk-free. And then you get a small spread for these others. Medium quality are the triple Bs. There's a lot of triple Bs out there. That's a pretty common. That may be the biggest, not the majority, but the biggest single group. That's medium quality. And then you get into high yield junk bonds below investment grade, the double Bs down the single B. They have the widest spreads, and they look a little bit like both stocks and bonds. So today I was talking to William today. He's saying, hey, well, high yield did pretty well today. So why might that be? Well, if we look at the market today, not a good day for the market, is it today? Oh my word, just since we started class. So the stock market's down. What about the bond market? What's the bond market doing today? Is the bond market up or down today? It's down. Yields are up. How much are yields up? No, not 178. Be careful on that. You're right that it's 178, but always ignore this number. This number shouldn't even be there. We never talk about bonds in this thing. So how much are bonds yields up? 6 basis points. Is that a big day? 6.5 is one standard deviation, kind of a mediocre day. Now, interestingly, gold is down today. Now that's strange, because what's driving markets today? Well, one report came out today that was really interesting. CPI, and it was a bad report. You would think gold would be rallying today, but then what's the dollar doing today? The dollar is actually up today as the euro is down. So gold loves inflation, but it likes weak dollars. So I don't know. I'm somewhat shocked that gold is down 1.6%. That's, you would have thought gold would be up today. The other issue you might have is that the gold investors are a different group of people than stock and bond investors. Gold might have been expecting a really bad inflation read, whereas bond and stocks are looking for a good one. So who knows? We don't know what's going on. We can't just look at this number and go, oh yeah, that's the obvious thing, because today it's not very consistent at all. That's a pretty big drop. Oil is down, but not dramatically today. So you would have been better off if you'd on gold. I mean, oil yesterday, you'd only be down 0.13% versus down 4%. 4% is a huge day. Remember, one standard deviation is one standard deviation is 1% on the S&P. So we're over 4 sigma event. That is a very, very rare. See if I can get this right. I usually don't. So how often do you get a day like today? This is the percentage. That's a 4 sigma event. So if you had a, let's say, how old are y'all? 23, 22? Or around there. So that's 8,000. You've been alive 8,000 days. Does that sound right? I've almost ridden my bike 8,000 days in a row. So okay, so you shouldn't have seen one day today. You should not have seen one in your entire lifetime. So today is a pretty, what does that tell you? Today's either an incredibly crazy day or the markets are not normally distributed. And that's probably, the latter is probably true. Does the day seem so shocking? Like the world's coming to an end today? It doesn't seem quite that bad at 4%. We remember on October 87, it was down 23%. What's the probability of being down 23%? It can't happen. October 87 cannot happen. In a trillion years, it couldn't happen. So today is not quite as big as October 80. What's interesting though is October 87, the Dow was down 700 points. It's down 1,300 points today. So it's down almost twice as much as it was on October 87 when it was down 23%. So markets are much larger today. But we were, and that was like the most disastrous day ever in stock market history, and it was down only 700 points, and now it's down 1,300. So it's good to have a good historical perspective. But yeah, this is a huge day. My next buy point on stocks is 3,700, so I'm not doing anything there. But my next buy point on bonds is 3.5. Should I do it early and go in, or should I wait for 3.5? I'm the kind of thing is I have these buy points to take the emotion out. If I start second guessing it, I'm putting the notes. So I'm just going to wait for 3.5. Probably what's going to happen is going to go to 3.49 and then markets rally and I'll miss the whole thing. So I had thought about that. If my target's 3.5, maybe I should go off 1 basis point and make it 3.49. Why? Because everybody, that 3.5 is pretty important to everybody. It becomes somewhat of a resistance point. So maybe I should come off a little bit of it. Anything else happening today is kind of bizarre. What about tech stocks?
More than 5%.
Over 5%. Is it inflation? Tech stocks don't necessarily hate inflation. They do hate high interest rates, so that could be part of it. Small cap is not doing that badly. So what does it mean when the S&P is off more than small cap and the Treasury is also down? That means inflation is probably the biggest thing driving markets. Small cap's more worried about recession than inflation. If the markets were worried that the Fed was going to overdo it and cause a recession, then stocks would be down and bonds would be up today. So that's called, you know what that's called? What kind of landing is that if the Fed messes up?
Hard landing.
Hard landing. Have you heard that term before? Hard landing, soft landing. Does that sound familiar? Y'all use it in money and banking? You're taking money and banking now, aren't you? So ask your money and banking, are we going to have a hard landing or soft landing, and see what she says. But a hard landing means the Fed so aggressively goes after inflation, they cause a major recession. A soft landing is they get it just right. We have a minor recession, but it's not too bad. They get inflation under control. That'd be a soft landing. A hard landing, bonds should be rallying. If the markets are really going to, if the recession is going to be really strong, bonds, people are going to be buying bonds, right? You move up in quality. So today the market's telling us, with one exception, that inflation's driving it. What's the one big exception? Gold is down today. That one I can't explain. If we click on gold, maybe an article will tell us. Yeah, there's no articles telling us why. Dollar rallies. Why would the dollar rally? Well, partly because inflation's around the entire world, but also if the Fed's going to be more aggressive, when is the dollar rally? When the Fed raises rates. Money and banking, really, really important. When does the dollar rally? Higher interest rates, lower inflation, lower government deficits. Those are the kind of things you're looking at. So when you get to that in money and banking, you really, really have to learn that. Extremely important. When does the dollar rally? When do other currencies? We'll talk about it a little bit in this class, but it's really more your money and banking. What a cool time to be doing money and banking. Hopefully you are really getting into it. I'm still gonna try to get Keith Phillips to come talk to our investment society. He's just one of the best economists around. All right, so pretty wild day. So today, I don't know what spreads are doing. I can show you spreads though. I haven't updated this in a while, so I should have. I kept thinking I should have. So I updated it in August. All right, so here, this is OAS, which is spreads, but with that option. Did y'all look up OAS this weekend? And see my definition or Investopedia's definition? So my definition is OAS, which makes a lot more sense looking at this chart, is it's the spread, but if you take out that option that you gave to the borrowers. So it's the spread you get without the option. So it's the credit spread. You know, which of these are high yield bonds, do you think? The blue up here or the blue down here?
The lighter blue.
Yeah, so the wider spread. So that's going to be high yield. You can notice a significant difference in spread for high yield. The only time I invested heavily in high yield was right here. I said, you know what, a 22,000 basis point spread, I'll take it. That sounds pretty exciting to me. And they rallied really, really well after that. And then the bottom line is AAA. You notice at AAA, you're getting almost nothing. You hardly even notice a AAA versus a Treasury. You're getting almost the exact same yield. And then BBB, you get some extra yield here. What have spreads done recently? Well, this is through August. Through August, they actually rallied a little bit. You can see spreads come down, they're rallying. So right here, you're going into recession. Do you want to own high yield right here? Absolutely not, right? Because when spreads widen, what happens to the bond price? It's going to be falling. So high yield just was down like 40, 50% in 2008. Just a horrible, horrible market. Same thing with even AAA. Saw some spread widening in 2008. Should you have owned treasuries in 2008? Yeah, they did great. You were up 25, 30% with treasuries. But then actually at USAA, I was trying to get them. We talked about it in my risk management class. I was trying to get them to buy this right here. They had a swap. I had purchased this swap. We purchased it for $0. It was trading for over $500 million. And I was like, sell that because that's like a treasury and buy this. And he said, we need to analyze it. It's like, what are you analyzing? I had the entire investment company on my side. Yeah, you need to sell that swap and buy BBBs. They said, we got to think about it. So they thought about it and made the decision somewhere down here. They gave up all of that. They probably threw away $300, $400 million because they wanted to analyze it more. Like, what do you need to analyze? We actually met on this day right here. I said, sell the swap for $500 million and go buy $500 million with the BBBs. We got to think about it. It's like, wait, you can't do that in finance. You don't get, and they want to spend 3 months thinking about it. And everybody investment company was telling me, hey, when December 31st, when January 2nd happens, this all goes away because there's a lot of people doing year-end window dressing that's keeping those yields wide. As soon as January 2nd hits, it all goes away. And sure enough, January 2nd hit and those spreads went away and they threw away a few $100 million. Got to be aggressive in finance. But those are the spreads. You should have, I think, some sense of what spreads normally are. I'm trying to find my worksheet that shows you that. All right, so here it is. So for AAA, the median spread is 24 basis points. So if the 10-year treasury is at 3%, what would a 10-year AAA pay you on average? What's 24 basis points? So the 10 years at 3%. What would the AAA be paying on average? Someone do it off the top of your head. Should be able to do it in nanoseconds. Too slow. So obviously I'm a horrible professor because you're not catching it. What should the spread be on that?
3.24.
3.24%. What would a double A be yielding? Just yell it out. Y'all should know it in less than half a second.
3.65.
3.65%. Are y'all seeing that or am I missing something? What about a high yield? What would a high yield have?
7.31.
7.31. Y'all see that? 431 basis points plus 3%. That's 7.31%. Get good at basis points because boy, they assume you know it. By nanosecond, I mean, you don't have to think about it. You just know, oh, 24 bips, 3.24%. So if that's not sinking in, come catch me in office hours. Just make sure you know that because it's really, really critical for finance majors to do that because that's the way finance speaks. Where were we? This is back in April. Yeah, I haven't updated this for some reason. Look how narrow they were in April. We're at 17 on the AAA. The AA was a little wider. So some of these are a little wider, but high yield was actually narrower. So it's kind of a strange world. Makes a little bit of sense because high yield doesn't care about duration. So when inflation's a concern, high yield may actually look pretty decent. That may be why high yield did well today, where other bonds didn't, because high yield's like, hey, we have inflation, it means the economy's doing well. That means our stocks survive. That's good for us. We like that. The max, look at that max, 153. That was probably 2008. If you can find a AAA bond paying 157 over treasuries, I would put all my money into it, unless there's something wrong with that credit rating. That's like getting Microsoft to pay you 4.57%. That would be really, really nice return. But look at AA. Isn't that amazing? Would you take a AA bond paying 439 basis points over treasuries? That's like a stock return. But with a bond that's, AA, it's unlikely, very unlikely to go insolvent. Yeah, I would take that for sure. And then high yield, 1,800 basis points. Just insanity. Yeah. So I would write these numbers down, this median. AAA is 25, AA 65, single A 100, triple B 150, high yield 450, something like that. Just so you kind of have a sense of what's going on. The hard thing is finding where the numbers are today. So if you want to do that, I have a worksheet that I use in Bloomberg, and you have to know these tickers. These tickers tell you what kind of bond it is, and you can't really tell from the ticker if it's AAA or AA or whatever. So it's a little bit messy. But you can take this. See, I did actually update this, but I just don't know where I put it. So maybe it's in here. There's 720, but I don't have the title in there. That's probably AAA, AA. So and there's high yield. So you can see high yield actually rallied in August because the spread narrowed. But look how much high yield's off from the beginning of the year. High yield started at 283 basis points spread, and at the end of July, there was at 469. So there was certainly some sell-off. So I need to update this sheet and show it to you, but do get a sense of what's normal. And this will give you a good sense of normal, and then where are we today? All right. So I think we're going into recession next year. That most of the time implies two things. The treasury yields are going to fall and spreads are going to widen. Anybody disagree with that? That's normal. I don't say it not happens all the time, but that's normal, isn't it? So if you expect a recession, if we get a soft recession, it's hard to say treasury is absolutely. It kind of depends on what the Fed does. how high does the Fed go? I should have brought I have to get the, maybe is your money in banking, are they showing you the Fed forecast and the Fed history? I should send that to you. You can take it to that class and bring it up. I mean, that's a class where you want to be doing a lot of current events because, well, you're in a very historical period of time. But it's interesting. On Bloomberg, you can just type Fed forecasts, and you can bring up this chart that shows you what the market thinks the Fed's going to do. Like this next meeting, is it 75 or 100 basis points? That's the big debate right now. There's also a big debate about how far are they going to go. Last time they went to 3% or 2.5%. The time before that, they went to 4, or they went to 5.25. Right now, they're getting up, in the 3s and the 4s, where they go as high as 4.5%. That would be a normal number. The 10-year Treasury has spent most of its history above 4.5%. You're somewhat at a disadvantage. You've lived your life in really weirdo times. So you're thinking a 10-year Treasury should be at 2%, but that's not the way I was raised. When I graduated college, 10-year Treasuries were double digits. They're 12, 13%. So you kind of have to get a historical perspective. But you can certainly go to that Bloomberg screen. You can click it back to the 60s or 50s, and it will show you where the Fed funds rate has been that whole history. And it's really, to me, really, really fascinating. You can see when they raise rates, they don't just raise them all at once. It's a stair step. So right now, this 75 or 100 is a pretty unusual jump in Fed. They usually go 25, 25, 25, 25, 25. If they do 75 or 100 all at once, that's pretty unusual. So we're in an unusual time. But normally, if you expect a recession, you would expect treasuries to rally as the risk-free rate falls, but you'd expect spreads on corporates to gap out. All right, so you need to increase quality and probably lengthen duration if you expect a recession. That would be normal. So if you get into an interview and they say, hey, what do you think on the economy? Who knows what you believe? Flip a coin before you walk in. Heads, I expect a recession. Hard landing. Tails, I expect minimum recession, soft landing. Just pick one. And if it comes up head, hard landing, you say, yeah, I think the Fed's going to get this wrong. I'm expecting a hard landing. Boy, I'd be moving up on quality and I'd be moving out on duration because I think we're going to have a hard landing. The Fed's going to have to start cutting rates a lot faster than they expect. I want to lock in this 3.5%, 4%. They may strongly disagree with you, but it's an intelligent answer. And they're not going to hire you because you agree with them. In fact, they should hire you because you disagree with them. That's what they're looking for. But it's an intelligent answer. I expect a hard landing. The Fed's going to go too far. Boy, I'm going to move up on quality. I'm going to move out on duration. That would be a very, very astute answer. But let's look at triple Bs. So triple Bs, before the recession, they had a 225 spread over Treasury. So Treasuries are at 5%. You bought a bond yielding 7.25. And then the recession hit and Treasuries fell from 5% to 2.5%. Well, that helps you. That's good. But spreads widened to 600 basis points. So what is your yield now? Now it's 2.5% plus 600 basis points. Now your yield's 8.5%. What did your bond do? You bought it yielding 7.25. Now it's yielding 8.50. What did your bond price do? It fell quite significantly. So you take minus duration. I don't know what the duration of this bond is, but if it's 10 years, minus 10 times the change in yield was 125, you would have lost 12.5% on your bond. All right, so you have all these moving parts and you have to consider all of them. Once your boss says, hey, I'm expecting a hard landing, there's a lot, you're definitely not going to buy high yield. That's obvious. Don't go in an interview, I expect a hard landing, so I'd be loading up a high yield right now. That's probably going to be the end of your, they're going to say, oh, sorry, I got a call, I got to take it, so nice to meet you. They're going to find some excuse to end the interview. They're not going to talk to you, but would you maybe do AA and AAA bonds? Yeah, that's pretty high quality. Would you necessarily move out on duration? It kind of depends, but the normal answer would be say, yes, you would move out on duration. So if the economy is expected to take off, you really expect a strong economy, normally you would expect the risk-free rate to rise and spreads to narrow. What about high yield in this environment? Junk bonds. Would you buy junk bonds in this scenario? Strong economy, rates rising. Yeah, this is the perfect scenario. Remember, high yield doesn't really care about duration. Rates rising, what do we care? Because spreads are going to narrow so much, we're going to more than offset that with the spread. So high yield, they just want to make your next payment. And if you go in a recession, there's a good chance they're going out of business. But if you have a strong economy, they survive, they're going to make their payments. So yeah, high yield be a good one. Triple B might be a good one here, but you probably want to shorten duration. So you might move from treasuries to triple B, but go from 10-year treasuries to 5-year triple B because rates are going to rise. So just, all right, so you see all the moving pieces. It gets a little challenging. So with bonds, you have two things going on. You've got three things: duration, convexity, and credit. Those are the main things you're looking at. We'll look at inflation and some other things, but those are the biggest ones. So strong economy, you're usually going to move down to lower quality bonds. Pretty simple. Strong economy, weak economy, you're going to move up to higher quality bonds. Pretty simple. What are you going to do on duration? If your boss just says they expect a recession, they don't say anything about interest rates, I would assume interest rates falling. If your boss says, I expect a weak economy, but I also expect rates to rise, boy, then you're not only going to buy treasuries, but you're actually going to shorten duration. So if your boss explicitly says the unusual, I expect weak economy and higher interest rates, that's somewhat of the 70s scenario, then yeah, you got to react to that. On question 2 on exam 1, I make it very explicit. I usually go more normal than abnormal, even though right now we're in a really bizarre area. It depends. I usually steal someone's outlook and write it as my own for the exam because I don't like putting mine down every time. Otherwise, it's the same exam question every time because I don't change my opinions all that much. So I'll find someone out there, Ken Fisher, or I've used US Victory Capitals before, whoever's got a good, so I'll see. I don't know what people are assuming right now for markets. So we'll practice that when we do the tactical side, but you need to put that, remember on the exam, on question 1, you want to define what do we mean by credit? What are the subcategories, high quality, low, medium quality, and low quality, and give me the tactical. If you expect a recession and rates to fall, do this. You expect a strong economy and rates to rise, do this. So that all needs to be in your answer 1. Now, with credit, work in the concept of sector or industry into your answer. That's been extremely important the last few years. So sometimes there's a particular industry that's really being hit hard. So right now it's technology. They don't borrow a lot of money, but back when oil prices fell, the $20 or even negative, people were worried about energy companies going under. During COVID, they're worried about consumer stocks, especially travel and leisure stocks going under. Right now, boy, I'm not sure right now because tech isn't. There is some concern about financials. There have been some concerns about banks and loan charge-offs. William was showing me the some not mortgage-backed securities, but auto loan-backed securities. And Bloomberg would actually, it's pretty cool. You can go on the Bloomberg, pull up an auto-backed security. So it's the bank takes all their auto loans and sticks it into a trust, just like they do their mortgages. You actually click on that and it'll list every single auto loan. And oh my word, people are buying used cars for $78,000. I'm not sure who these people are. I don't spend $78,000. I didn't spend $78,000 on my condo, so I don't know. I'm not an asset person. I don't believe being owned by my assets, my houses and my cars. I like to travel. That's where I splurge. But some people having an expensive car. If I buy an expensive car, what does it mean? Look at the middle-aged guy going through a midlife life crisis, right? That's what it means. I don't want that, so I buy boring cars, and people are like, yeah, they don't even notice me in my Prius. I buy cheap cars, but some people buy expensive cars. You can actually list every single loan. You can see how much how much the car is worth when they bought it. Some of them are buying cars that are priced 130% of the actual value of the car. So when they drive it off the lot, they were losing 30% right off the top. Pretty amazing. So, our banks worried about the quality of these auto loans, the mortgage loans. Are we in, we're looking at housing prices falling. Y'all know what an LTV is? What's an LTV? Someone tell me that. Some of y'all work in that.
Loan to value.
Loan to value. Do you work in that industry?
No, I wouldn't.
But you might sometime. Loan to value. So how much did you borrow versus the house price? When house prices are falling, what's happening to loan to value ratios? They're rising, right? What's a good LTV? Maybe 80%, 70%, but if the house price falls and your LTV is now 100%, that's pretty dangerous for banks. So you can actually go on Bloomberg and look in detail and see which of these loans are in trouble, which ones may not pay off, which ones have missed payments. And that gives you a lot. And so that's an event risk. So you'd be avoiding bank debt right now because they may have these issues. All right, so here's the four categories you normally think of. The normal ones are these two blue ones. So spreads widen, the risk-free rate falls. That's your recession scenario. Normal recession. And recession, lower quality bonds, they're going to gap out. They're going to widen in spreads because they're more likely to go insolvent. And the risk-free rate's going to fall because the Fed's cutting rates, okay? What about spreads narrow and the risk-free rate rises? That's your strong economy. That's your recovery. Risk-free rates going up because the Fed may have to start raising rates to slow the economy down. Spreads are narrowing because companies are doing really, really well. So those are the most normal ones. This is what I want you to assume unless I tell you otherwise. So you see strong economy, expect the risk-free rate to rise and spreads will almost always narrow. If you expect a recession, expect the risk-free rate to fall and spreads to widen. 1970s, we saw risk-free rates rising and spreads widening. Why? Because of inflation, especially oil prices. That was when I was in middle school and high school. That's the economy I grew up in, where we just thought everything was falling. We were more depressed back then than y'all are today. We thought the US was over. Japan was the only country doing anything right. People writing books about we should all copy Japan. The US has been and it'll never recover kind of thing. So I was coming out of high school thinking, you know, all is lost. What am I going to do? And then the 80s happened. Corporate bond prices, risk-free rate fell and spreads narrowed. Why? Well, all the inflation of the 70s was fixed in the 80s. So the economy did really, really well and risk-free rate fell because inflation was coming down. So what do you notice about these two unusual environments? These were two environments where inflation was driving everything. The rise in inflation and the fall in inflation. So where are we today? Inflation is driving everything. You see why we're in an unusual period? When inflation's taking off, it makes it much more difficult for me to come up with scenarios. The 80s and 90s, if you didn't make money in the 80s and 90s on your investments, you shouldn't be investing money. It was so easy back then. We were upset when stocks didn't make at least 12, 13%. That was a bad year for stocks. It was just easy pickings. Almost nothing you could buy that wasn't going to make you a lot of money. You have questions? What are your questions on this? This is a pretty important little chart.
So I had a question. So like where it says price can rise or fall, spread narrows, risk-free rate rises. Actually,
Well, I'm talking about corporates here.
Okay, because I was thinking like, for example, like 2017 through 2019 before the pandemic, we had a pretty good stock market. So I was just thinking like, so high yields, that was a good time to buy them because we had a strong economy.
Yeah, stocks probably did better, but yeah, high yield, because the problem with high yield then is the spreads have come down so much since 2008. You weren't getting that. You did well. You were getting, 6% instead. The reason I say rise or fall, I'm talking about corporates. So corporates, you don't know if the rise or fall because you don't know if the risk-free rate falls 50 basis points, but spreads gap 100, then the price falls. If the risk-free rate falls 100, but spreads gap 50, then you actually make some money. You'd make more money on the treasury, but you actually make money on the corporates. So it depends on what does the risk rate fall more or do spreads gap out more? If you're buying a AAA bond, more than likely the risk-free rate is going to fall more than the spreads gap out because they're very high quality bonds, except for 2008, right? 2008 was a pretty crazy year. And in fact, I did an analysis 2008 where I showed the corporate guys, 2008, the numbers are actually worse than the Great Depression for corporate bonds. It was a pretty horrible year. We were panicking at the end of 2008. It's hard to think about it now, but we were essentially thinking, is the world coming to an end? And there was one weekend, boy, I remember this weekend. Well, I shouldn't think about it. I'll have nightmares tonight. But we're going in Friday, going home from work on Friday, and Lehman's in a lot of trouble. And the Fed's going to try to bail Lehman out, but they can't get anybody to buy Lehman. Lehman's the biggest bond shop in the world, really, really good bond shop. And if they don't get Lehman bought out, then Merrill Lynch is going to go under. If Merrill Lynch goes under, Morgan Stanley is going to go under. Morgan Stanley goes under, who else is going to go under? There's only one more left. Bear Stearns is already going under back in February. So you only got one more left. Who's the last one? Lehman, Merrill, Morgan, starts with a G. Does it help? Goldman. So if they don't bail out Merrill Lynch, they lose on Lehman. Lehman's done for. They don't bail out Merrill Lynch, those other banks are all going under. I had a swap with Morgan Stanley, so I'm worried. I actually called the guy who had the swap. Said, you need to sell the swap and get out of it. He didn't do it. He should have done it. So I'm worried that could have been. You thought 2008 was bad? It would have been the end of the world. I don't know what would have happened. We would all be, farmers today. For some reason, Bank of America, the last second, bought Merrill Lynch at a ridiculous price. Merrill Lynch was worth, who knows what, $12 a share. They bought them for $30 a share. Why did they do that? I'm glad they did, because they saw it would have been just mayhem. People think they did because Bank of America is this North Carolina kind of not respected bank, big bank, but not respected. It's not one of the money center banks like JP Morgan. They say, hey, we're going to buy Merrill Lynch. Look at us. We're the big guys now. And so I'm sure glad they did. Boy, that was great. And then Barclays bought Lehman. Barclays did it right. They waited until Lehman was worthless and then bought him out. For some reason, Bank of America bought. I can't even imagine what would have happened if Bank of America had not bought Lehman. Now think about it. Merrill Lynch. Merrill Lynch has a balance sheet where no one has a clue what anything on it is worth. They have these assets that are so complicated, they don't know if they're worth 10 cents, 20 cents, 50 cents on the dollar. Would you buy something like that at twice its value? Does that make any sense at all? But am I glad they did? Yeah, I'm glad they did. So anyway, we'll see what happened. When Fed starts raising rates, sometimes these things can happen. All right. Any other questions on that? Really, really important chart to understand. All right. There's a few other examples in the notes. You can just go through them and practice yourself using the formulas. You notice there's no convexity in here, and that's because I'm not having interest rates move that much. But convexity could be something else to bring in here. Okay. Let's start with the next one if there's no questions. So before I do that, off the top of your head, no notes. What is DC cuts I? You can do all of them. Make sure you can do all of them before you start. Joshua, you can do all of them. Can you? Don't look at your notes. You can't look at your notes.
Just look at the DC cuts part.
Duration, convexity. We just talked about the next C.
It's credit.
Credit.
Utilization.
No. Okay, you got 3. That's pretty good.
US
US versus non-US. They just hired 80,000 people. What's the T? Somebody, AAA? No. Juan Carlos? No. It's not for Texas, but real close. Change one letter and you switch 2 letters and you got it. Taxes. The S. Structure, the I, what we talking about just recently. Inflation. All right. I don't care if you know it for an exam, you need to know it for life. So know this for the rest of your life. This is a very good DC cuts I will get you jobs and fixed income. Sure, you can take John's class and you'll go much, much deeper, which is great. But if you don't take John's fixed income class, DC cuts I is going to get you into a lot of places that it's a good list. I have not found anyone to add any other letter to it. All right, so the U here is really unusual. This you got to be a little careful on. There's a U under stocks for bucks. It's the same U for US versus non-US, but radically different analysis. All right. For bonds, US versus non-US, what happens is because bonds are not as volatile as stocks. Bonds are pretty calm. So when you buy a bond that is in non-US currencies, the currency takes over. It's no longer a bond, it's now a currency. And so very few people buy bonds in non-US and outside of their own currency. It's very rare to do that. Why? Because you end up with something so volatile. USAA was thinking about adding a non-US bond portfolio mutual fund, and Cliff, the head of the department, he said, I don't want to do it because people are going to see this high quality bond fund that's in, UK and Europe and say, hey, well, look at that yield. That looks really good. And they're going to be shocked when it loses 20% because the US dollar rallies. And so they were like, no, I don't want, that's too much. So for most people, non-US bonds, non-US denominated bonds are usually an alternative asset class. It's usually not under bonds. Why? Because currency so dominates everything else. You're really, more than anything else, you're not buying bonds, you're betting on a currency. And that can be really, really dangerous. What currency would you bet on right now? The dollar has been really strong, hasn't it? So this might be the wrong time to do dollars. Maybe this is the right time to buy non-US. We see the euro is the lowest it's been in 20 years. The pound's really, really weak. The yen is the weakest it's been. Boy, I can't even, if you show me the yen, I would have said you did your math wrong. 20 years ago, I wouldn't have believed that number. So maybe, and you can do that. There are mutual funds that have bonds that are denominated in other currencies. So you can do that, but just be ready to hang on. When would that win? Well, if the Fed only raises rates 50 basis points, that would probably cause the dollar to sell off if everybody's expecting 75 or 100. So you're solely making a bet on what the Fed's going to do, but it's not even that. It's a relative bet. So currencies are relative. You know what zero-sum game is? Have you ever heard that before? If the dollar gains, what does that mean?
Someone else would.
Other currency had to lose. That's just the nature. It's impossible. It's impossible for every currency in the world to go up. That can't happen because they're priced against each other. So it's zero sum. So it's all relative. So you say, well, the dollar's going to strengthen because the Fed's going to raise rates. Well, what are you implying then? Well, that means the central banks of Europe and UK and China are not going to raise rates as much. So it's a relative plays that you expect the Fed to raise rates more than Europe. And so far that's been true. What does that mean for Europe? Well, a weak currency does what for inflation in Europe? So what's inflation in France right now? It's probably not 8%, is it? It's probably higher than that. And why is that? A weak dollar does what to inflation in France? Shoots it up. Why? Because imports to France are going to be much more expensive. So if the euro declines 20%, that means everything you buy in France is going to be 20% more expensive. So a weak currency causes inflation. So in the US, that's great. We have a strong currency that keeps our inflation at 8% instead of 10, 11, 12% like you're seeing in the UK. The negative is what happens to people exporting from the United States? What's their problem? Everything they're exporting is what now? More expensive. So Europe has the advantage where their exporters, man, our stuff looks cheap. We can sell a lot of stuff overseas, but our imports are really expensive. So it's hard to say, do you want a strong currency or do you want a weak currency? And the answer is yes. Yes, you do. That is the answer. What does our federal government say? We want a strong currency. And then what do? They do everything to weaken their currency that they can. Why? Because a weak currency makes politicians happier. But is any politician going to go out and say, we want a weak dollar? No, you're not going to say that. That's un-American. So there's a lot going on here. You really, if you're going to, most of the bond managers I know that manage non-US bonds, most of them have a PhD in economics. You've got to understand Fed policy, interest rates, inflation. The guy I hired, we did do some non-US investing. In fact, the bond department, they were managing our Europe operations, and they came to me and said, Ron, can we get rid of this? Because we don't want to come in at 2 a.m. when these markets are open. We don't understand these markets. And so I actually said, okay, we'll outsource it. So I went and found a manager in the UK that would manage all of our currencies. And we just outsourced the entire thing. They were really happy about it. So I'm taking money away from you, but you know, they're managing 25 billion and I took 100 million away from them. So they're like, who cares? It was really interesting. It's one of the most interesting presentations I did because the CEO, made me do my presentation. At the end of my presentation, he says, does anyone have a clue what Ron's talking about? Everybody said, no, we don't. Does anyone have any reason not to approve it? Everybody said no, so they approved it. So that was, it's like, great. I did a horrible time presenting, but you still approved it, so I guess I'm happy. So yeah, you got to understand inflation. That's why your money and banking class is so critically important. You've got to understand what drives interest rates, what drives inflation, why does inflation rise, when does it fall, what has the Fed, what is QE 1 and 2, what's the Fed doing, how does that impact interest rates, inflation, the economy. That money and banking class is one of the most important classes you're taking because that's the foundation of how finance talks and how investing works. So learn that stuff. I don't know, how's the textbook in that class? Are you yawning when you're reading it? Or are you like bouncing off the wall, calling your relatives and say, you can't believe what I just read here? You know, which is, it should be the latter, shouldn't it? It should be like the most exciting book you've ever read in your life because this is really, really critical stuff. There are a few ways to look at currencies. The most popular, which you might cover this in your money and banking. Have y'all talked about PPP, purchasing power parity, in your money and banking class yet? Or if you take international business. So what purchasing power parity says is, if you're going to buy something in Canada that's also sold in the United States, you shouldn't be able to go to Canada, load up your SUV, come back to the United States and sell it and make a profit. You shouldn't be able to do that. So if something costs X dollars and Canadian dollars, when you come back and sell it in US dollars, you should break even. Okay, that's purchasing power parity. You can look up purchasing power parity on Bloomberg. And then the economists, they thought it was a joke, but they did it anyway. They wrote this article and they called it the Big Mac Index. What they said is Big Mac is the most global product out there. It's very similar in most countries. It's a little different in India, but in most countries it's the same inputs. You shouldn't be able to go to Canada and buy 1 million Big Macs, drive back to the United States, buy them 1 million Big Macs in Canadian dollars, drive back to the United States, sell them in US dollars and make a profit. You should break even. That's the Big Mac Index. And so if you look up the Big Mac Index, you can actually look it up. They've got a list somewhere. Yeah, they didn't put it here. So there's the US dollar. It's pricing it off the US dollar, but you can actually look. Oh, here it is over here. All right. The Swiss franc is always overpriced. So that means, you know, you can go to Switzerland and buy a bunch of Big Macs and come back, you know, or maybe it's the other way around. I have to think about this index, but the Swiss franc is overpriced. So do you want to short the Swiss franc? I say, well, yeah, it makes sense. It's 30% overpriced, but it's been overpriced for decades. So you may be waiting a long time for that to play out for you. What's the cheapest? Czech, Kuwait, Romania. So should you buy a bunch of Romanian whatever? I don't know what that is. Lays, I don't know what, I don't know their, or Indonesia, their currency, the South African rand, buy their currency, you know, sell dollars, buy their currency and hope they rally. It doesn't quite work out so perfectly because it can go a long time before it corrects itself. But the US used to be at the bottom of this list. And you notice today, the US dollar is pretty close to the top. So the US dollar really has rallied. So the US dollar used to almost always live down here. It'd be interesting to see where the yen is. Did y'all see the yen? Y'all stop me if you see it. There's the peso. There it is. There's yen, 45% under price. Well, I have to think what that means. So I think that means you go to Japan and buy a bunch of Big Macs and you come back to the United States and sell them. I think that's what that means. It'd be a good time to travel to Japan, wouldn't it? Hotels would be 40% cheaper. Rental cars would be 40% cheaper. Everything would be really cheap right now. Big Macs would be 45% cheaper. Not that I would go to Japan to have Big Macs. I might try sushi for the first time. Who knows? I don't know what their big thing is. All right, so that's what you do if you're buying these bonds, is you're trying to figure out the currency play almost more than anything else. There's a guy I was helping with his portfolio, and he's from India. And he said, well, I can go to India and buy certificates of deposits yielding 10%. And certificates of deposit in the United States are only paying 1%. Why don't I just go buy Indian certificates of deposit? And I say, well, the only way that works out, the reason you can get those CDs so high is inflation's really high in India. So if you do that, the only way you win is if their inflation suddenly comes down unexpectedly. Then you would win. But if their inflation stays exactly how everybody expected, then you'll buy those CDs in India. And when they mature, you'll come bring them back to US dollar. You end up with the exact same return you would have gotten if you bought the CDs in US. So how's the only way he wins is that India's inflation comes in below expected. So is it a good investment or not? He has to figure out what Indian inflation is going to do versus US inflation. And if he makes that trade, right, he's like, yeah, forget it. I can't make that determination. All right. So for the most part, this is not an asset class most people do. One thing you notice in the notes, I'll get a little bit more in this. When you go into emerging countries, and this is really a specialized asset class. This is everybody, almost everybody. This is all the time. We never did emerging market debt where I work, but emerging market debt is usually an alternative asset class. There you're getting a little bit more than currencies. You're also getting a little bit of credit analysis because some of these countries are, on the edge of just going under. Argentina, anyone want to loan Argentina money right now? You want to loan Brazil money right now? What is Brazil about to do? You know what's happening in Brazil? I don't know when it is. A big election, isn't it? So anyone want to bet on that? What's the thought there? Is that the guy in power, he may claim it was an illegal election. He may have riot in the streets. He may go to the military and have a military coup. Is that a good time to be investing in the country's currency? Probably not. But if the market's expecting all that to happen and you don't think it's going to happen, maybe it would be. If the election happens, everything's fine, there aren't any riots, then you would make a gain. Are you willing to make that bet or not? Would you loan money to Chile right now? Chile just had an election, didn't they? Voted a new constitution. It failed by a wide margin. Maybe that's good for the currency. Who knows? That's the kind of thing you're looking at as an investor. You see, you have to have some really good knowledge to be able to do that. You saw how many currencies there are. That's how many governments there are. That's how many central banks there are. There's so many things going. What about Turkey right now? What's Turkey doing?
80% inflation.
High inflation. Why? Because their president says if you have inflation, you should be cutting interest rates. Does that make any sense? He didn't take your money in banking class. He somehow missed that class. So I don't know. Turkey, maybe he gets ousted in the next election. They fix it all. Maybe this would be a perfect time to buy the Turkey currency. Who knows? But a lot of unknowns definitely there. All right, the T for taxes. Right. So with taxes, there are some bonds that have been given special tax treatment in the United States at the federal level and sometimes at the state level. If your state has an income tax like California or New York. These are normally municipal bonds. They don't have to be municipal bonds. Municipal somewhat implies city government, but it can be city, state, county. It can even be special revenue districts. I would bring in current yields to show this, but Yahoo Finance has stopped showing yields. I don't know why they did that all of a sudden. So these are somewhat dated numbers. So since municipals are tax-free, you can't compare their yields to a corporate bond because corporate bonds are taxable. So we have to make an adjustment. Now there's another professor here who thinks I'm doing this all wrong. And she's right, it is all wrong, but it's the way the industry does it. So I teach it the way industry does it. She teaches us the way that's more logical. I agree with her, her way is more logical, but it's not the way it's done in practice. So I'm going to show you how it's done in practice. If you take her class, she'll show the other way, just be aware. So I would say, let's look at the numbers here. So let's look at the highlighted ones. So the intermediate taxable, this is a taxable fund, so it's got corporates in it, is yielding 3.27. The tax exempt is yielding 2.82, but we can't compare these numbers because this is tax-free and this one has to pay tax. Now, her approach is the most logical. Let's reduce this yield for taxes. So if your tax rate's 20%, let's reduce that 20%. So take 0.8% of that. Makes perfect sense, but that's not how it's done in practice. What they do in practice is they increase this yield so that they both look like before tax yields. And what is called the tax equivalent yield. The tax equivalent yield, they take the tax exempt yield, not the taxable yield. They don't do anything with the taxable yield. They take the tax exempt yield and they divide it by 1 minus the marginal tax rate. So you take that 2.82%, and let's say your tax rate's 25%, you take that divided by 1 minus 0.25, you get 376. So if these are both taxable, this one would be yielding 376, this one 327, which one would be better? Here the tax exempt, if your tax rate's 25%, the tax exempt is the better one. What if your tax rate 0%? Which one would be better? Taxable. You get 327 versus 282. That is your after tax, right? Now on the exam, I always have a student that will take the taxable rate and divide it by 1 minus the marginal. They'll do them both. You don't do them both. You only adjust the tax exempt, and then you take the one that's higher. On the exam, on the tactical question, I give you a taxable fund and a tax exempt, but the same duration, same credit quality. So the only difference is taxes. Because if I don't do that, if this was a 10-year bond, and this was a 5-year bond, then I got duration in there. So I got more problems. Or if this was a BBB bond and this was a AA bond, I got credit. So I'll make them all, everything's exactly the same. And these two bonds that I'm using, these are actually Victory Capital funds. And I actually own both of them. These are the same credit quality, same duration. The only difference is taxes. So if your uncle says, hey, I want to buy some bonds, your first question might be, well, you got to figure out the duration, the credit, and all that. But once you figure that out, say, okay, you want average credit quality, kind of BBB bonds, and you want a 5-year duration. The only thing you got to figure out is, should you buy taxable bonds or tax exempt? All right. Now, a strange thing has happened here recently. I wish I could show you. Here's the numbers as of 1/5 of this year. You can notice here the tax equivalent yield is 365, much, much higher than the taxable. But what's happened this year, really bizarre, is right now the tax exempt yield is actually higher than the taxable even before adjusting. So even if your tax rate was 0, the tax exempt is higher. I emailed my friend at Victory Capital. I was like, what are you guys doing over there? And they said, yeah, we can't explain it either. For my entire career, let me tell you how weird the world is today. My entire career, tax exempt yields are almost always below treasury yields, not below corporate. They were below corporate yields, but below treasury yields even. Today, they're well above treasury yields and even above corporate yields. I can't explain that. It just does not make any sense at all. There's something bizarre going on with, I don't know if they're expecting California to go insolvent, or we know Illinois is a disaster, but their yields are much higher in Illinois than they are in Texas. So I don't know why that's the case. It's really hard to explain, but that's what you got to do. So you got to put this formula on question 1. And in question 2, there's only one math problem in question 2, and that's this formula right here. It's the only math. The second exam has all math. This first exam, that's your only math question.
So it will be even both yield and also the marginal tax rate. It's just going to be a plug and chug and remembering.
I'll probably give you the marginal tax rate and the effective tax rate, and you ignore the effective.
Okay.
Because you're making a marginal decision. Now, I don't know what Biden's tax policy is. Trump actually cut the highest marginal tax rate for individuals. That would make tax exempt less valuable. That could be part of what's going on. If Biden increases that top marginal tax rate, that will make tax exempts more valuable to the wealthy. So government action can definitely influence these bonds. Should we do this? There's been a lot of studies that say the government should completely get rid of this treatment of municipals. And what they discovered was the reason they do this is to help municipals. Because if if their bonds are tax-free, they can pay less on their debt. It saves them money. But what studies have found is the savings to cities like San Antonio are more than offset to the loss of the federal government. So the federal government would be better off taxing these like normal bonds and just giving that money to the states and cities. Will that ever happen? I don't know. We have so many tax benefits for the wealthy, and this is one of those that goes almost exclusively to the wealthy. Do the wealthy need tax breaks? I would argue maybe not, but this is a tax break for the wealthy. And it's a tax break for the wealthy that harms the federal government more than it helps states. So we end up all worse off except for the wealthy. So yeah, not on making any political comment. I'm just saying that's what the studies have shown.
Question, I'm really related to this topic on the taxes or no, but does capital gain taxes, any change in it? Does it affect the taxes in fixed income or?
Well, fixed income capital gains, it's a little bizarre because if you buy a bond, we'll talk about this more when we price bonds. So you can buy a bond at a premium or at a discount. A discount when its yield is lower than what the market's paying, so it pays 2%, but the market's 4%, so you get a discount. When you buy a bond at a discount, so you buy it 900 and it matures at 1,000, you got a capital gain on that.
On that one.
If you buy it at a premium, that's kind of a nice thing that you get a tax deduction at the end of capital gains. If you sell the bond before maturity, then you get capital gain treatment just like you would anything else. So yeah, these bond funds do think about that. If they got a lot of realized losses, they may realize, especially if they talk about a tax exempt fund, the income's tax free, but if they have capital losses, they can realize those, and that can actually help. So you get the income tax free, and you actually get a tax deduction. What tax exempt funds will almost never do is sell bonds to create a gain, because their investors hate it. Say, hey, it's tax free. You're telling me I got to pay capital gains tax. So they're real careful. So they don't like buying discount bonds. It really messes them up. So they tend to try to buy bonds that are right at par or a little bit of a premium. Yeah. So they play a little bit of a game because they know their customers are, in fact, some of their customers are, I don't care how much money I make, I just want to pay tax. So they'd rather make 2% and not pay tax instead of make 7% and pay tax, even though they're better off paying taxes because they hate paying tax so much. They're like so anti-paying tax. They actually hurt themselves not to pay tax. And you got to realize that when you manage a fund like this, that you really manage that tax. Other questions on the taxes? Ask some of your rich relatives if they're buying municipal bonds, and if they're not, ask them why, because municipal bonds right now are paying a ridiculously high yield. So if you got an uncle that's worth 10 million bucks and he's sitting in bonds and he's sitting in taxable bonds, I would ask him, why in the world are you buying taxable bonds? Be careful how you ask it, because he may take you out of his will, but try to do it in a political way. All right, structure. We could spend the next 6 years on structure. This is really taking over finance. So in the exam, I'm keeping this really, really, really simple. So the PhDs in finance, they discovered they can make a lot of money by doing complicated things. They refer to it as financial engineering. That used to be a good word. Now it's a bad word. I think it's becoming a good word again. What they said is, we can buy a bunch of bonds and then we can carve them up. We can carve up this part of it to them, this part of it to them. So we'll buy a bunch of mortgage-backed securities, and then we'll carve up the different pieces. Someone might be worried about prepayment risk, so we'll create a bond that's really protected from prepayment risk. It gets CLOs, and you know what that is? What's the C? So if you loan someone money, what do you want backing up that loan? Collateral. This is a collateralized loan obligation. What about this? CDO, collateralized debt obligation. That's when banks take a bunch of their loans, they put them into a security, and then that security borrows against those loans. That's CLO, CDO, PAC, and IOs and POs. There's a few others out there. Those are mortgage-backed securities that have been carved up in different pieces. So what the PAC does is says, some of our investors, they're worried about interest rates falling and getting prepayments. So we'll create a special bond for them that's protected from the most extreme so most of the time they won't get prepayments. IOs and POs, my word, you talk about something complicated. This is when they take the mortgage-backed security and they carve it up so one group only gets interest payments and the other group only gets principal payments. So if someone comes in and pays off their whole mortgage, they can get all their principal payments, and the IO people aren't going to get anything because there's no more IO, so they get crushed. It's just you want to cause a bond person to go catatonic. Ask them what the duration of an IO and what the duration of PO is. They'll have to sit down. It takes me like 30 minutes. I have to sit down and do the math. It's very, very complicated. And what the convexity of these things are as well. Very, very complicated securities. There's even CDO squared. A CDO squared is when you take a bunch of CDO. So a CDO has a bunch of bonds in it. CDO squared is you take a bunch of CDOs, have a bunch of bonds, you put a bunch of those CDOs together in a CDO. It's like there's almost no way to analyze those kind of bonds. It's just complexity on top of complexity. But you'll see this word. I think this is a French word, but I don't know how to pronounce it. I've always pronounced it tranches. I know people pronounce it tranches. How would you say that in French? Trauchn. I think it's a French word. Does that sound like a French word? No? That's what I've been told. So it shows me what language is that? Tranches. It's not Spanish. So what do y'all think? Tranches or tranches? I think it's tranches, but okay. Someone needs to look at the origin of that word. Because you want to pronounce it correctly. You don't want to go in an interview and say tranches and they're saying tranches. So what that means is you buy a bunch of bonds, you just start carving them up in different pieces. So you might buy a 1,000 treasuries and you're going to make some are going to be zero coupon treasuries, some are going to be, real short-term treasuries, whatever. Or you might create a bunch of zero coupon treasuries off of that. And then you repackage them into this distinct pieces. Some are going to be high quality, some are going to be low quality, some are going to be very protected from interest rate changes, some are going to be very sensitive to interest rate changes. And you're going to carve them up and sell them off. It's beyond the scope of this class, but these bonds are a good 50% at the Fabozzi Fixed Income Handbook. It's a big chunk of that book. But the wonderful thing about this, if you can specialize in any one of these, it can become your career. It was fun talking to William earlier today, and he's just showing what he was showed on his intern of how you can dive deep into these bonds. Really, really interesting stuff. So you can become quite specialized. They are more complex, which means they're slightly less liquid than other bonds. So you do get a little bit of spread because of their complexity. So that compensate you for their complexity and liquidity. They can blow up in a year like 2008. These bonds just really, really blew up in 2008. Anybody want to guess what CMBS is? And it's not collateralized. You know what MBS is? We already covered that. Mortgage-backed securities. So what do you think the C might be?
Collateralized?
No, it's not collateral. You're real close, not corporate, but that's the concept. So you got residential real estate and you have commercial. These are commercial mortgage-backed securities. These bonds blew up in 2008 and they shouldn't have. You could have made a fortune if you bought CMBS in 2008 because they fell dramatically and they were up like 70-80% in 2009. All right, so next class, okay, we're done. So next class, we'll finish up with inflation. Some charts you can get out of Bloomberg. So there's the Federal Reserve. You can see, look at historically, like this is the one before the 2008 crisis. Can you guess what the Fed's going to do next? They raise rates 25, 25, 25, 25, 25. That was just stair step up. But what happens on the way down? On the way down, it's total mayhem. So they try to be real controlled on the way up, and then they're just, the pandemic there. People are talking about 75 next week or 100. How unusual is 100? If you go back, we haven't had 100 since really in the 80s. There's a few places in here that were like even 200, 250. I always think of 94. In 94, there were some 50s and maybe a 75. What you notice with 94 is just how fast it was. So 94, yeah, they increased rates. 94 was a really bad year for bond markets. The stock market was slightly positive in 94, so it just did okay, not great, but at least didn't lose money. But the bond market definitely had a bad time of it. So where will they stop? Well, I mean, if you look at that, you can go on for quite a while. They got up to 5%. Are they going to get up to 5% this time? Who knows? But it's good to have a good history of the federal, and so you can actually get this out. I mean, some of this one looks just like the Sears Tower, doesn't it? I mean, they just went crazy here, up and down, up and down. Who knows? Obviously, you know, it's Volcker coming in. Y'all know Volcker. Y'all study Volcker in money and banking. You know, he came in. There was a Fed that just didn't know what they're doing. Poor Jimmy Carter had really high inflation, and then Ronald Reagan had 2 recessions as Volcker tried to get inflation under control, and then they seem to have done it. And then you look at this period after the financial crisis, the Fed just, it's hard to go negative. You can go negative. You've seen in Europe, there's actually, they're going negative where you have to pay someone money to hold your money. Would y'all do that with your bank? Our savings account is negative 0.5%. You could store your money under a mattress. That's a little dangerous. It's hard for corporations to do that. Corporations can't take, like USA might have $300 million. They could, I guess, give it to all their employees. Can y'all take this in cash and hide it on your mattress? Unlikely you're going to put $340 million under the mattress. $5,000 maybe, but even that's pretty dangerous. It might get to the point where if you know you got $100,000 and they're going to charge you 0.5%, you might take it in cash and put it in a safe deposit box. So it's zero other than the cost, you know, so who knows? So there are some limits. Our Fed never went negative. This is the upper end. So this is 25 bips. So if you show the range, it was actually 0 to 25. That range that we're so used to, 0 to 25, 2 to 2.25, that's brand new. That was just a few years ago. So for most of its history, there was just one number. I forget exactly where they went to the range, probably somewhere in here. But 5% was pretty normal. 5% or higher was pretty number. Even here, people will say, oh, they're going to increase rates back up to normal. Here's the .com crash and Enron. And then we came out of that, everything looked good. And you got the 2008 crash. They were pretty fast. So 100 on the way down is not that unusual. When they're freaking out, they'll cut 100 basis points pretty fast. But 100 on the way up is pretty unusual. You notice how much steeper this is than the previous ones? But we haven't seen 8% inflation since back here. So, you know, it makes some sense. Another one is a forecast. So you can actually get a forecast of what does the market think the Fed's going to do. And so a rate hike, rate cut, the implied rate hike. So you can see right now for this next one, the implied is 82 basis points. So somewhere between 75 and 100. They'll even break it out to what percentage thinks it's 50, what percentage thinks it's 75, what percentage thinks that. This is a great chart. I'd really encourage you to get this chart. You could actually work this into your paper. It's probably too late now because you're writing a paper 2 Fridays ago. If you load this, it will be up to date. But I'll let you get something like this. I'd let you get away with it just because I think it's really cool stuff. So here they show you, and if it's interesting, you look here, they're expecting a rate increase, but actually as early as mid next year, they're already starting to project rate decreases. So they think the rate's going to get up to 425, 430, but it's actually going to start declining. Why do they think that? The Fed control inflation. If we get a few more 8% inflation numbers, they're going to freak out, aren't they? That's their number one job, is to control inflation. We can't have many more 8%. If you're an investment society, last night I was explaining why an 8% inflation implies the stock market's grossly overvalued, because it should be a much lower level with these inflation numbers unless it's temporary. But anyway, so you can actually get a forecast of inflation. And then the important component of this beyond just the rates is the Fed balance sheet was a brand new thing. QE and QT, I've heard those terms. You think of QE as like, oh, we've always talked those terms, but no, that we never said QE when I was working. It's a brand new term. So the Fed's balance sheet getting up to what, 8 trillion or whatever it is. They own a lot of treasuries. They own a lot of mortgage-backed securities. You can notice it hasn't come down, but they're letting it somewhat just mature off the books. If they start selling this, that's really going to impact. What they like about QE is the Fed funds rate is only the short-term rate. And the Fed gets really frustrated where they can move the short-term rates, but they want to move long-term rates because that's where car loans are and mortgages. QE, they can move longer-term rates. And that's one reason. In fact, Greenspan, he was like he called it a conundrum. He's trying to, I don't know, I think he was cutting rates. He was cutting the Fed rates, but the long rates weren't coming down. He's like, come on, guys, what's your problem? Well, here's how they can get that longer term. If you buy a bunch of treasuries, 5-year, 10-year treasuries, you're going to cause those rates to come down just because, you make the price go up. This is real, I should have gone back more years. This is most of the time, it was just this little brown part. So you're living on unusual times. You're seeing things, oh yeah, $8 trillion the Fed. That's, if you'd gone in a time machine 20 years ago, they would have thought, yeah, you're making a mistake. There's no way that's true. They would never have believed it. So we've done some stuff in these last few years. QE, buying the Fed, buying treasuries and mortgage backs. We would have never thought we'd ever do that ever in the history of our country. Stimulus checks, y'all think that's pretty normal? We've never done that before. And once you do it, what does the government think? Wow, that's kind of cool. When's the last time the government did a stimulus check and people said, I really don't like that. I wish you wouldn't do that. It's pretty popular, isn't it? So if you're a politician, what's your go-to thing now? And 10 years ago, I said, no, we'll never do that. That's crazy. Now it's like, it's the first thing they're going to think about, except for inflation, right? Now they say, oh, look what you did, all this inflation. So Bloomberg has a lot of stuff. I don't know, AAA, what you find some pretty cool stuff, right? It's almost overwhelming. You can't look at everything. You tried the eco function, right?
Sure.
Yeah, there's like, you just keep clicking. So let's finish up just the last one, inflation. So get used to the term nominal and real. You may be using that in your money and banking class. So nominal means what? What's the current nominal 10-year treasury yield? So if we look at the current 10-year, the current 10-year is 3.46%. But what's the current nominal 10-year? Kind of a trick question. Your current nominal 10-year is what? No guessers. Some are like, it seems obvious, but it might be 3.46%. That is the nominal. Y'all see that? That is the nominal treasury. The nominal is what it is. That's going to compensate you for inflation, plus there's going to be some real term in there. What's the real term? You take that and subtract inflation. So right now the real rate is, if you subtract 8%, is like negative, big number. So we'll talk about tips. I used to be able to find tip yields, but they changed their website, so it's hard to, oh, you know what I can do? I think it's on H15. No, it's not. Well, let's see. If you type H15, you get the Federal Reserve. Let's see if it's in here. I think it might be in here. So September 13th, why is it the 13th and not the 14th? So there it is. There's nominal. So nominal is the actual stated rate that you see. You have tips, the inflation indexed. What these do, and we'll talk about them, this 5-year, this 1.02. If you buy that bond, you're going to get 1.02%. And then at the end of every year, they're going to kick in inflation. So this is a really pretty amazing bond right now, 1.02. The 7 years at 198, 109, pretty amazing. Wow, it's almost a good time to be buying them. So yeah, you're getting a really good. So that implies inflation right now. If the 10 years at 342 and the 10-year tip is at 90, that implies inflation is like 2.242%. Do y'all think inflation is going to be 2.42% the next 10 years? If not, you would avoid the nominal 10-year and you'd buy the tip. If you think inflation is going to be like 1% the next 10 year, you'd buy the nominal and avoid the tip. So the tips look really good. In fact, this number, I wish I could show y'all. They don't allow you to do this. This number has been negative for almost continuously last 3 years. It's not negative now, but it was very, very negative for the longest time. In fact, like negative even 1.7%, 1.8%. This number got up to 3% at one point. I was tempted to sell everything I had and buy 10-year tips. Because can you imagine you get 3% plus inflation risk-free? That's a really good investment. It's going to be interesting what tips will do at the end of this year. They're actually going to throw in 8% on the end of that. But this is pretty crazy what's happening with tip yields. So I didn't think tip yields on the 10-year could ever go negative. I just didn't think that was possible. And they went negative, 0.7, 0.8%, pretty amazing. Why would someone buy a 10-year bond that assures them they're going to underperform inflation? And that's what a negative 10-year tip yield means. You're going to get inflation minus 1%. You still get protection. If inflation goes to 10%, at least you made a 9% return, but you're still going to underperform inflation. So the nominal yield is the actual stated yield. That's the actual yield. The tip yield is a stated yield, but you're going to get that plus inflation. So this is essentially a real yield. So y'all probably use the word real yield in your money in banking. A real yield is the yield you get after you subtract inflation. Since tips pay you this rate plus inflation, the tip yield actually is the real yield. I have a former student. It's so hilarious. He's an economist. He's radically impacting. I mean, he's on TV constantly, Fox News and CNN. It's just amazing. He was on, what was he on the other night? Oh, Dr. Phil. Yeah, it's just amazing what he's doing. But he's talking about education spending, and he always says public education spending is up 180% in real terms. And it's just hilarious every time he says that, because someone comes in and says, "You idiot, you got to adjust that for inflation, because you adjust for inflation, it's not up." What did he just say when he said public education spending is up 180% in real terms? What did he just say? He already adjusted for inflation. But it's so funny to see these people. So all of his friends have started teasing him now. Every time you use the word real, they all come on and say, "You idiot, you got to adjust for inflation," because they know it's going to happen. So now we don't know if it's his friends or it's an actual idiot, but it's pretty hilarious that he gets that every time. So real means you've taken inflation out. It's that number. So we have a new bond called inflation-linked bonds. They're known as TIPS. Treasury inflation protected. I don't know what the TIP actually stands for. They pay a real yield. That's a stated coupon. And then the principal, not the coupon, but the principal is adjusted for inflation every year. All right. So if they adjust it this year for 8%, next year you're still going to get that 1%, and they'll adjust it for next year's inflation. Now, inflation next year could be negative if energy prices come down and food prices come down. So a negative inflation's not unheard of, especially because energy and food are so critical. Y'all have noticed it with gas prices, haven't you? I mean, I don't buy gasoline, but I've noticed, boy, gasoline has really been dropping pretty fast. So you get the real yield plus you get adjustments. So you're protected for inflation. Now, these are brand new bonds. They've only been around for 20 years. It would be nice if you had more information, because if you go back historically and want to know what the real yield is, you can't get it anywhere else. TIPS tell you what the real yield is, but you can't go back to the 70s to get the real yield, because the real yield is not the nominal minus historical inflation. The real yield is nominals minus expected inflation. And we don't know what expected inflation is historically. I mean, we can look at economists' forecasts and those kind of things, but this is the market. What does the market thinks inflation is? But now, because we have TIPS, we can actually figure out what the market's expectation for inflation is. Now, if you go in the class notes, I have a YouTube that shows you how to bootstrap the yield curve. I strongly encourage you to learn how to do that. Any of y'all know how to bootstrap the yield curve? You might want to do this for your money and banking class. I think the professor would be pretty impressed. No one knows. So I won't show you in here, but you can watch my video. But essentially, you have 5-year treasuries and 10-year treasuries. And if you look at the 5-year treasury and the 10-year treasury, the bond market's telling you what they think the 5-year treasury is going to be in 5 years. And you can actually figure that out. It's called the forward curve. Have y'all heard that? The forward curve. So the forward curve is what the treasury market is telling you they think interest rates are going to be in the future. Well, now that we have tips, there's also the forward inflation number, which tells you what the bond market thinks inflation is going to be in 5 years. That's pretty impressive. And in fact, I was at an inflation conference with a bunch of economists, and they said that Greenspan and Bernanke, their number one thing they look at for inflation is that forward inflation number. Because their opinion is that the bond market's freaking out about inflation, we better be freaking out about inflation. And so they look at that future, it's called the break-even inflation. What is that inflation in the future that makes you indifferent between the nominal bond and the tips? So it's pretty cool that we have this, because we can now actually do quite a bit of assessment of what the bond market thinks things are going to do in the future. So it gives you essentially a forecast of inflation. In fact, when I was at USAA, we're spending thousands of dollars for forecasts for inflation and interest rates. And so they sent it over to me because my department became responsible for it. And I looked at it and said, they're giving us the forward curve. They're not forecasting anything, they're just giving it. I was like, why are we spending $3,000 for the forward curve? We can do that ourselves. So we canceled that and we just started using the forward curve, which, you know, what's nice about the forward curve? Well, you're writing your paper one on the jobs report with expectations about the jobs report. What happens to an economist if they expected 300,000 jobs and it comes out at 500,000 jobs? What happens to their job? They lose their job, they get fired, nothing happens to them. They probably get a promotion. What do we like about the bond market in their forecast? If they're wrong, they lose money. They have what we call skin in the game. Have y'all heard that before? So the bond market's forecast, I think, is a superior forecast because they have skin in the game. They're not just telling you what they think, they've actually got money invested betting on that. So when the 5-year treasury yield is higher than the 10-year, the bond market's telling you they think future 5-year yields are going to be lower than they are today. If the 5-year is lower than the 10-year, they think future 5-year yields are going to be higher than they are today. So it's a forecast, and you can actually bet on it. So if you watch my YouTube, if you think the bond market's wrong, you could buy the 10-year and short the 5-year, or you could buy the 5-year and short the 10-year. You could actually put a trade. You can actually bet on what you think 5-year interest rates are going to be in 5 years, and you could put that bet on the day. And if you're right, you can make a lot of money. If you're wrong, you can lose a lot of money. So there is what we call the break-even inflation. The break-even inflation is what's that inflation rate that makes you indifferent between the nominal treasury and the tips, because the tips, the difference in the two of them is one page of inflation. Now, one problem with these bonds is when they came out, the bond market really wasn't used to these. They have existed before. I think the UK has had inflation-linked bonds for a few extra decades, and I think Australia's had them for a long time, but the US has only had them for 20 years. And the bond market didn't quite know how to handle them. So you think in a year when inflation surprised on the upside that these would do really well, but they actually didn't. So they're a little surprising. The bond market's still trying to figure them out. If you want to really freak out a bond investor, just ask them what is the duration of a tip, and they'll give you a blank stare. I remember Dee at USAA, smart lady, PhD in math. That was my favorite question. Hey, Dee, what's the duration of tips? And the next 40 minutes, hour, she was in her office, working on it. She had the math skills to do it, but it's a very complicated problem. You can actually even Google that and just see what comes up. I don't know what would come up. What is the duration of tips? Tips and depth, the nominal duration of tips, bonds, treasury, inflation. And so a lot of these will just calculate duration like we're going to, but you can't do that with tips. If you calculate that, that's the duration of the real yield, but you got a nominal yield, so you don't really know the duration. It can be all kinds of, so it's an interesting thing. It's the same thing with convexity. So it creates some complexity we've never had before, and so the bond markets had to figure that out. And so the first few years of these things, it was pretty uncertain. It was funny at the conference, at this inflation conference, tips had just come out and people were talking about it, and they had a Federal Reserve I think one of the governors speaking at the conference, and he was telling the story that was, I thought, a little humorous, in that when these bonds came out, they really wanted the bond market to accept them, but they were new and unheard of. And so someone said, well, the Federal Reserve should buy these bonds to show that they're perfectly fine bonds. And the Federal Reserve said, our job is to keep inflation in control. And you're asking us to buy a bond that protects you from bad inflation. That doesn't look good. Looks like we're buying a bond in case we're really, really wrong. And that's not what we want to tell the bond market. So you don't want the Federal Reserve buying bonds to protect them from inflation. That just sounds horrible. So they are a unique bond. I don't know who is buying them when they had a negative yield. Now they look pretty good. Actually, this is my first time looking. I'm kind of interested to go buy some tips because, wow, 1% plus inflation, that sounds pretty good to me right now. So if you're really, really worried about inflation, yeah, you can look this up. I do have a YouTube in the notes that you can do this. It's a really cool thing to do. It's actually pretty simple. I think it's 3 or 4 YouTubes and each one of them about 5-10 minutes. But if you expect inflation to be really, really high, you could buy tips to give you some protection. If you don't expect inflation to be very high, you probably wouldn't buy tips because they're generally not going to be a very high. Now, my risk management class asked the question, could you buy inflation-linked corporate bonds? They don't exist, but could you buy one? And I think what you could do, you could buy a corporate, you could short a nominal treasury and buy a TIPS, and I think you would end up with a inflation-linked corporate. So I think it's possible. I've never tried it in real life, but I think it could be possible. I should ask my friends at Victory Capital if they'd ever thought about doing that. Starting a bond mutual fund, which is inflation-linked corporates. I think it'd be a pretty cool thing to do. But so it's all about what you think about inflation is going to be. Our tips, the only thing to protect you from inflation, well, we'll talk about commodities and real estate, but this is the only thing that's directly tied to inflation, where it's just obvious that it's going to pay you inflation. So yeah, it's an interesting bond. All right, that's it for bonds. So let's get into stocks, also known as equities. So on the exam, you need to give quite a bit of an introduction to stocks because they're unusual. They're a little different. So bonds, you're loaning people money. You don't have any ownership. You're loaning them money. They're going to pay you back. The only time you get ownership, if they don't pay you back, then you can take over their company or get the collateral. Stocks, you're actually an owner of the firm. So I was talking to the previous professor. They were talking about Uber. Said, oh yeah, I bought some Uber stock when it really sold off. It's so far been a good trade. We'll see if it keeps going. Uber looks terrible right now because they have losses, but that's not how I looked at it. I looked at it, what if Uber gets back to pre-COVID? They look really cheap right now, and they're doing some pretty exciting things. So I went for it. So I own Uber. How much of Uber do I own? I don't know, 0.000000001% of Uber. Does that give me some power? Yeah, I can vote my proxies. Will they care how I vote? Probably not, because I'm a small investor. But I have ownership in Uber. As a stockholder, I get residual ownership. So I get everything left over after they pay their debt holders or other vendors. I get the residual. This is pretty critical to how the US and its markets develop. We take it for granted, but this idea of limited liability is I don't know, pretty earth-shaking. Some people don't like it, but if I invest in Uber and they really blow up, they just mess up royally. Every single one of their drivers crashes at the same time. They got all these lawsuits, and the firm goes under, goes out of business, and there's still another $20 billion of lawsuits. How much can I lose? Everything I invested. Can they come after me and say, hey, you lost all your stock, but we have all these other claims. We need you to pay those. Can they do that? No, the most I can lose is 100%. We take it for granted, but that's not true. There's a place called Lloyd's of London. Have you heard of them? You want to invest in Lloyd's of London? And Lloyd's of London, if they lose money, they call you and say, hey, you need to contribute more because we ran out of money. You have unlimited liability. They just keep drawing on you until they get everything taken care of. That doesn't sound like a good investment to me. So we have limited liability. Some people think this is really critical to the success of the US and how we've grown over time. If you let someone say, hey, you know what, if you're wrong, we just go in bankruptcy, everybody just loses 100%. Eventually, you know, taxpayers or employees, vendors, we all lose, but you as an investor, the most you can lose is 100%. That's actually a pretty valuable thing because what's the most you can make? The sky's the limit. That's kind of nice. The most you can lose is 100%. I was talking to someone, there's a high school student that I've been mentoring. He's trying to find, he's going to do a pitch book, and we're trying to find a strategy. So I took him to Art Capital, and he'd heard of Kathy Woods and her strategy. And I said, it's not a bad strategy because let's say when I got out of college, I invested in 20 stocks. Let's say 19 of them went insolvent. And one of them was Microsoft. How did my portfolio do?
Really good.
Really, really well. Now, how is that possible? I was wrong 95% of the time, and I made a fortune. Because 19 times I lost how much? 100%. One time I made 80,000 or whatever percent. Yeah, it's so her strategy, she doesn't have to be right all that much. It's the kind of strategy where you buy 20 stocks, and that's what I'm telling you, you buy 20 stocks and you never rebalance. You just let them ride. So if you rebalance, that's going to hurt you. You just got to let it fly until one's like 99% of your portfolio. So for someone in their 20s, I don't think it's a bad strategy. So we're talking about what is that next big idea? Is it artificial intelligence? Is it virtual reality? Is it autonomous vehicles? Is it electronic vehicles? Is it battery? Is it microbes? I just read a book on microbes. I just found that really, really fascinating. They're curing diseases that, I mean, it's really, have you ever read some of this stuff? People are coming in with these diseases that are just debilitating. They have one treatment and the next day everything's cured, they're normal. And it's like, it's amazing what we're discovering here. You have nanotechnology, you have 3D printing. What is it that's really going to take over the world? You don't have to get them all right, but if you get one of them right, you can make a fortune. And that's this limited liability. If we didn't have limited liability, and then those 19 that lost money, they can, you know, if it's Enron, they can keep saying, give us more money because we haven't paid off all the debt holders yet. So it's an interesting approach. I've seen papers where they actually argue we should do away with this. But what would they do? What would they do to investment and stock markets and those kind of things? It would definitely change things. All right, so here's the important part on stocks is what is a stock? And it's actually very, very simple. As Warren Buffett says, it's simple but not easy. So a stock, when you buy a stock, you're getting current dividend yield plus earnings growth. That's essentially what a stock investment is. If you buy Walmart, Walmart has a dividend yield of say 2.5%. How fast is Walmart's earnings going to grow? Maybe 4%. So Walmart's going to give you about a 6.5% return. Google, what's Google's dividend yield? 0. Earnings growth, maybe 8-9%. So Google's going to give you 8-9% return. There is one other piece called repricing, but that's just noise. That's markets just fluctuating around. But your long-term return on the stock is their current dividend yield plus earnings growth. Now, I've always heard that my whole career, and so I said, well, let me test it. So I decided I didn't update this for the recent stock market decline. But what I did is I went back to 1871. When you see 1871, there's one person that comes to mind, Nobel Prize winner. Anybody know who this guy is? Taker is 1871. So there's 2 years you'll see 1922, that's Dr. Ibbotson from Chicago. But 1871 is a guy named Robert Shiller. Does that sound familiar? And there he is.
So the one that made the Schiller Index, or?
Yeah, K. Shiller, yeah, this same guy. Nobel Prize winner. So you can actually do his online data. There it is right there. It takes you all the way back to 1871. Now, how did he find the stock market in 1871? He's giving you the S&P 500 in 1871. Standard & Poor's didn't exist in 1871. So how in the world did he do that? But here's his data all the way back to, he's saying the US stock market in 1871 was 4.44. Today it's about, well, it's fallen below 4,000. How do you know? What was in the US stock market in 1871? Maybe a few railroads, a few banks. I can't really think of, I don't even think, I think Thomas Edison wanted the light bulb, 1879. I don't think Alexander Bell, there was no telephones, there was no like AT&T, no Exxon, we weren't using oil, there's no cars. So I don't really know what was in the S&P back there. I don't even know anything about the US stock market back there, but he has data back there somehow. I don't know how he did it, what data he found to do that. And he goes from there all the way up to the present. Let's see how this looks, because he's been saying the stock market's extremely expensive. He did this. This is through July. So it doesn't have this recent sell-off, but remember the recent sell-off, we had a rebound and then it sold off again, and we're still above this level. So we're about where, so this isn't that far off. So what he's saying here, this is an interesting chart. When the blue line is high, he's saying stocks are overpriced. Where's the blue line right now? Higher than any previous stock market except for the dot-com crash and the 1929 crash. So remember the 2008 crisis? There's where we were in 2008. We're higher than that. So he's saying we're at very high levels, extremely expensive stock market. When the red line is low, the bond market's expensive. What do you notice about the red line? You see the treasury yields coming up. So, but we're still fairly expensive on bonds. So essentially what he's saying is stocks are expensive and bonds are expensive. I think it was a podcast, I think it was Cliff Hassness was saying nothing's radically expensive right now. So he doesn't quite agree with Schiller that the stock market's this expensive, but his argument was nothing's radically expensive, no bubbles, but everything's expensive. So things may not be 5 sigmas expensive, but everything is like at their 96th percentile. Stocks are expensive, bonds are expensive, real estate's expensive, commodities expensive. So there's no place to put money. Maybe emerging market stocks are cheap, but who wants to be in those right now if the US Treasury is going to keep rising rates? So, you know, where do you put your money? But he's saying the stock market's very, very expensive. So, you know, how long it take me to get data back to 1871? You just click a button and you got it. A lot of really good data. So the way he does this is he takes earnings compared to the stock market, but he adjusts the earnings for inflation, which is really, really critical. So you can't say, well, stocks look expensive, but inflation is really low, because he's adjusting for that. So he's taking real earnings and looking at the price to earnings for that. And with this is high, you can compare these periods. So it doesn't matter what inflation is because he's adjusting for inflation. So he's saying, so you might say, well, stocks are cheap here because inflation is so high, but he actually adjusted for that. So the earnings are much lower. So he should have a higher number. Stocks really were cheap back here. Stocks really were ridiculously expensive right here. No question. Bonds were great. In 1981, you can buy treasuries at 12, 13% yields. Yeah, that was a cheap bond. You should have put all your money in the bonds in that year. So you can somewhat see the chart. So what I'd wanted to do is taking his data back to 1871. I just want to ask the question, is that really true? Does the stock market really give you dividends plus earnings growth? So this blue line is the actual return on the stock market. There you see the 1929 heyday. Then you see the Great Depression and that bear market. Then everything recovers coming out of the war. You have a really good market, and then you get the disaster of 1973, 74 when inflation took off. But recovered on that. Then we had the 80s and 90s where nothing could go wrong. There's the 2000 dot-com bust. What do you notice about that? Didn't quite get back down in the red line. Then you have the 2008. For like 17 minutes in 2008, Robert Schiller was saying stocks are cheap. Didn't last very long because the stock market came back, but that was the first time in a very, very long time he said stocks look cheap. And you can see why, because this red line, what I did with the red line, I took each decade and took its dividend yield and earnings growth just to see. So you can see it does an incredibly good job, doesn't it? All the way up to 2008 until when? Here and here. So there's a couple of things going on here. Either the stock market's materially overvalued, which is not good, or the world's different today than it was in history. So what could happen? I can give you another answer that doesn't mean this thing has to sell off 40%. Remember, this is a log normal chart, so the distance from here to here is quite massive. So there is something else that could be going on. So it could be that stocks are extremely expensive, or it could be that the discount rates come down. It could be we're using a lower discount rate for stocks. Now, why would that be? That would mean that stocks are less risky today than they were in the past. I do think there's something to that argument for two reasons. First of all, during this period, it was extremely expensive to buy stocks. Y'all won't even believe this. You have to go Google it. In the 70s, if you picked up the phone and called a broker and traded stocks, it would cost you $40. Not in today's dollars, but in $70. It would cost you $40 to do a stock trade. Isn't that crazy? How much does it cost you today? Zero. So in the 70s, it was expensive. And information wasn't widely available. We didn't have the internet. If you bought Coca-Cola stock back here, yeah, 4 times a year, they'd mail you their annual report, and it might come out 3 months, 4 months after the end of the quarter. Really old information. What are you going to do with the information? Say, well, I have to key it from the annual report. Well, key it into what? Oh, into my calculator. You don't have a calculator. You're going to key it into your slide rule. I mean, it's really hard. So it's much cheaper trading stocks, and I can see they're less risky because the information is much more available. So if that's the case, that doesn't mean stocks just keep outperforming like that. What it means is there was a one-time adjustment for lower expenses, lower risk. And that one-time adjustment, what it means is going forward, these two lines will just go parallel. So you'll go back to dividends plus earnings growth after that one-time adjustment for the discount rate. So that's the other argument you can make. There are people out there like Jeremy Grantham saying it is going to drop 40, 50%. So he is making that argument. And there's others. I just saw a guy today saying we just hit bottom. We're going to come back from this. He's missed it from today because the market was down quite a bit today. Who knows? I'll have to update this for this recent one. You can see it was going sideways there for a while. I do think this is true for the stock market. The stock market does give in dividend yields plus earnings growth. So what's today's dividend yield? So if we go to Yahoo Finance and we type in SPY, anybody know what SPY is?
S&P 500.
It's a mutual fund or ETF that trades on the S&P 500. Its current yield is 1.46. So that's the current dividend yield of the stock market. What's earnings growth for the stock market? We'll talk through that here in a little bit, but maybe 5%, 6%. So the stock market's pricing to give you anywhere from like a 6 to 8% return. Does that sound great? 6 to 8% return. In the 70s or 80s and 90s, we were thinking 13, 14% returns. That's what we got used to. Not only get used to it, we actually thought that was what we're going to get going forward. It made no logical sense. This is a very, very low yield. Now for paper 3 and 4, I'm going to give you some offset to that. So what are firms doing today besides paying dividends that they didn't do historically?
Stocks?
Well, stock splits want to adjust this too much, but you're in the right idea. What else do they besides stock splits? They're buying back their stocks, stock buybacks. Historically, stock issuance and stock buybacks was a slight negative. Firms were issuing more stocks than they're buying back. That's no longer true. Today, they're buying so much of their stock back that that's actually a higher number than the dividend yield. So this dividend yield is low. That's because firms are paying dividends or actually buying a lot of stock back. Now you have to ask the question, this is the last 10 years. The last 10 years, firms have been buying more stocks back on net than they're paying dividends. Is that a one-time thing, or that's going to be permanent going forward? We know firms like Alphabet and Uber and those type of firms, they prefer to buy their stock back than pay dividends because they don't want to sound like some old economy company that pays dividends. Apple finally threw in the towel and started paying dividends. But buying stock back is key. Not only that, but there are actually firms. One of my favorite firms, really like AutoZone. But look at AutoZone's balance sheet. What do you notice about their net worth? According to the accountants, they're insolvent. Is AutoZone insolvent? What is AutoZone doing? Look at the cash flow statement. What do you notice about their stock buybacks? They bought back $4 billion of their stock. Would you buy back someone's stock that your net worth would go negative? AutoZone says, yeah, we'll do that. It makes it really hard to analyze the firm. What's the return on equity on a firm whose equity is negative? Makes it really, really difficult, doesn't it? They're not the only one. There are firms out there. I don't know about Marriott anymore, but Marriott was in that category. Whoa, I typed something wrong. I don't know what firm that is. Marriott, M-I-R. I typed it right, but I don't know what came up here. Marriott. You look at their, let's see if their net worth has come back positive. It has, but Marriott for the longest time, their net worth was negative because they were buying their stock back. McDonald's, let's see if McDonald's is still negative. Yeah, McDonald's, did y'all know that? McDonald's net worth is negative. Does that mean they're insolvent? Does it look like McDonald's out of business? You go to McDonald's, sorry, we're insolvent. What are they doing? Look at the cash flow statement. They're buying $5 billion, $5 billion, $3 billion. All right, so do we have to adjust for that? We'll talk about it in paper 3 and 4, because if you don't, you're going to get a little bit of a strange answer for stocks. So it essentially doubles that dividend yield. So it looks like the dividend yield is really, really low right now, but it probably isn't that low. The other thing we have to worry about, though, is that this stock buyback is pretty concentrated in a few industries. It's not every industry. So that's the other adjustment we have to think about. But it is really bizarre what's going on right now. So that could be the other thing. I actually, sometimes when I do this chart, I was starting to actually adjust for stock buybacks the last 10 years. It doesn't have a huge impact, but it does bring the line down a little bit. So, I mean, it brings the red line up a little bit. So it's not quite so extreme. But I do think this is true. If you're buying a stock, your number one thing is how fast are the earnings growing? You're going to have to handle that in paper 4. How fast are the earnings growing? And I don't mean the next year or two. I mean next 50, 100 years. How fast will Amazon or Alphabet, how fast will their earnings grow the next 100 years? I don't know. I hope they're both out of business in the next 10. I hope someone comes around and puts them out of business and does it better than them. But who knows? I remember Circuit City, that y'all never heard of because they don't exist anymore, but Circuit City was on the front of the Business Week or something, one of the US best run companies, one of our article, they were insolvent a few years later. Just amazing how fast this world changes. So, all right. So here's the tough part. What is expected return on the stock market, the earnings of companies in the stock market? In your paper 4, you have to talk about expected earnings growth for whatever company you chose to value. So I'm going to make the argument that the expected earnings of the companies in the S&P 500 is going to be closely related to the expected growth in our economy. So those two are highly related. And if you look historically, corporate earnings growth in the US has fairly closely mirrored our economic growth. And that makes sense. Last night in Investment Society, Alex was talking about where does economic growth comes from? And he had C plus I plus, I forget what he had, G plus I plus C plus exports, imports. So you got governments, you got corporates, you got consumers. Consumers are the bulk of that. But corporates are a piece of that. But is it possible for the corporates to grow their earnings at 20% if our economy is growing at 5%? Well, that's not going to work unless consumers are going to shrink. Because the three or four pieces all have to add up to the economy. You can't have one growing at 20% with the other two shrinking. So they're going to stay fairly in line. But just to show you, historically, I love this chart. So the green line is our economy. Here's the growth in our economy. You can actually see COVID in there, can't you? Pretty good drop. The red line is the growth in corporate earnings. And what you notice is the first time in history, corporate earnings have grown in line with our economy. Why is that? Well, margins are really nice and wide. Corporations are doing really, really well. Some people say, well, corporations are doing well, but consumers aren't. I actually remember I was listening to McNeil Lair one night, I forget the guy's name, but there was like a really bad employment report and the stock market went up, and he says that proves the stock market hates the US consumer. I'm thinking that's kind of stupid. Why did the stock market react like that? Well, because they're worried about Fed raising rates, and a bad employment report meant that we're going to. What the stock market reacted to was also good news for the consumer, but he was saying no, the stock market hates the consumer. Well, does Apple want the US consumer to do badly? No. Who's their customer? US consumer. There's not like this battle like when we hope the consumers just lose their jobs and all their incomes go down. No, it's not this battle. They're the same people. So they've got to get together here. So this is pretty, if I bring this forward, you're going to start seeing this red line start coming down again. We know this green line was negative for 2 quarters. So, you know, the green line is starting to come down a little bit, but historically, corporate earnings have not grown quite as fast as the economy. So our economy has grown at 6.47%. Corporate earnings have grown at 6.41, but that's this somewhat strange phenomenon here recently. The purple I put in there was 5%. The reason I put there is 5% has been a fairly decent low end on corporate growth, earnings growth. We'll talk about that. And then I put the 10-year treasury yield. The reason I did that is there's a really famous professor, Dr. Demodarian, and his philosophy is corporate earnings growth should match the 10-year treasury. So if the 10-year treasury is 5%, you should expect corporate earnings growth to be 5%. Now, I think he's pulled back on that. When the 10-year treasury dropped down to 0.5%, I don't know anybody was expecting corporate earnings growth to be 0.5%. So that was kind of ridiculous. So I think he's pulled back on that. But it doesn't look like a bad number. It seems like to somewhat go right in the middle of that red line. Now, what you should notice about the red line is far more volatile, isn't it? Who caused this? So Jocelyn, you're accounting major, right? So Jocelyn's profession caused this. This is all accounting, not her fault. She'll probably fix it. But why did the accountants say, hey, we really love fair value accounting? Let's mark everything to market. And in 2008, I remember at UTSA, our poor life insurance portfolio manager, he had a $15 billion portfolio and had to mark it down 15–20%. He caused his firm net worth. We didn't do fair value accounting back here. But in 2008, when all those bonds sold off, banks and insurance companies were writing down billions of dollars in assets. And then what happened in 2009? They wrote them right back up. So they lost all this money in 08, wrote them back up. So this is really just repricing stocks and bonds to market, something we didn't do back here. Had a huge impact. And it really was driven by financials, tech stocks, consumer stocks. You know, some of them lost money, but they didn't lose that much. So it really is a phenomenon that was really concentrated. So that's just a bunch of noise. But it's still, even before fair value accounting, corporate earnings are more volatile than the economy. But I think I can make the argument that if you expect our economy to grow at 6%, you should expect corporate earnings to grow somewhere around 6%. I think I can make that as a strong case. Now, some people said this is the S&P 500. So you should expect the S&P 500 earnings to grow more slowly than the economy. And why is that? Well, the S&P 500 are large companies. A big part of the growth in our economy are these brand new companies that just started up, small companies. And they're going to be growing at 7, 8, 9, 10%. So the S&P should grow a little more slowly. So I can see that argument as well. But I tend to go, they should grow somewhat in line. But so that raises the question, the next question, how does the economy grow? And I'm going to give you 3 pieces. Our economy has inflation, labor growth, and productivity. One thing I don't have in there is exports, imports. You know, that's somewhat of a negative number, but I'm somewhat ignoring that. So our economic growth historically has come from those 3 pieces. So you can see inflation got really high in the 70s and was still high in the 80s, but it's been coming down since then. We'll see what happens here recently. In labor growth, high in the 50s, real high in the 60s, real high in the 70s. What was going on in the 60s and 70s? Do we make child labor legal again in the 70s? What happened in the 60s and 70s? You don't have too many choices. You got men, women, and children. Women started joining the workforce in the 60s and 70s pretty heavily. So yeah, that had an impact. What's going on in Japan right now is interesting. I came back from vacation and President Abe had been assassinated. It's my word. And UK fired Johnson. I was like, my word, I shouldn't go on vacation anymore. I thought it was horrible what happened to Abe. But you can see speeches of him trying to get more Japanese women to join the workforce because their participation rate's much lower than the rest of the world. Why does he want to do that? Because you get more workers, you get more economic growth. How do you get more women to join the workforce? You can look, add more daycare services or whatever, but it's a tough log. But in the US it worked. We got more women joining the workforce, but you can't do that. And look in the 2000s. The 2000s is the first time in US history. Well, I don't know about the Great Depression. I have to go back and look. But at least in the last 50 years, 70 years, the first time we actually had fewer workers at the end of the decade than when we started. Now, most of that is we hired far too many bankers and far too many house construction people in the 90s, and we had to let them all go in the 2000s. We've come back pretty strong since then with good 1% growth in this last decade. But the most important number by far is productivity. Check time. All right, so productivity, what is productivity? It's actually a really simple number. So how does the Federal Reserve calculate productivity? So you should know this formula. Hopefully you're talking about this in money and banking as well. Really, really critical number. So if our nominal GDP grows 6% and real grows 4%, what was inflation? 2%. And if hours worked grows 5%, what is productivity? So for productivity, you don't want to use nominal growth because it's messed up by inflation. So let's ignore inflation. So our economy grew at 4%, but we added 5% more people working. What does that sound like for productivity? Is that good or bad? So productivity would be what? It's actually quite simple, -1%. What if hours worked went up 1%? What would productivity be? 3%. That's what the Fed is saying. Look at how our economy grows, taking out inflation, and compare that to hours worked. If we can produce more with fewer workers, we become more productive. If we can produce more, but we have to have a whole lot more workers, we're becoming less productive. And this is what you can call the wealth of nations. This is the #1 driving force behind living standards. If there's any one number you want to be strong in a country, it's productivity. One of my favorite writers, I just forgot his name, Robert Arnott. He did a whole study on this. I actually have his paper if you want to read it. It's several years old. It's a little old. But he's asking the question, where should you invest in the world? And he said, you should invest in the world where productivity is the highest. Right? Actually, it didn't say that. This is the change in productivity. And so he said, you want to go invest where the change in productivity is highest because that's where the wealth is the highest, that's where earnings growth is the highest. So he asked the question, US versus say Malawi. I don't know how to spell Malawi. Let me do Mari. I don't know how to spell that either. Nigeria. Which country has higher productivity? Not change in productivity, higher productivity. US, higher productivity. Which country should have the higher change in productivity? Nigeria. And why does he say that? Younger workers. That's how he spelled younger, but no. Who's more productive, an older worker or a younger worker? An older worker has a lot of experience. They know exactly how to do things. A younger worker has got a lot to learn, but whose change in productivity is going to be higher? A younger worker or a older worker? Younger workers. So his argument, countries with younger workers are going to see the biggest change in productivity. And that's where you're going to see most of the growth. What's going on with Japan right now? Aging population, people are dying. They're selling more adult diapers and baby diapers. Yeah, it's just going to kill productivity. Japan needs to figure out something. You can see why Japan is begging their women to go to the workforce, because their workforce is dying. They're retiring. They're getting too old. It's really tough. Japan has had a struggle with immigration, getting people to immigrate in Japan. I'd love to move to Japan, but I don't think I'm really bad at learning languages, unfortunately. I can't learn Spanish, and I'm in San Antonio. I've been learning Spanish for 15 years now, and it's amazing how bad my Spanish is. I don't know if I can learn Japanese. Can you go to Japan and survive on English? Do you think? Probably not. I go to Costa Rica, and you can, the taxi drivers can speak Spanish fairly well, but you really can't survive with English. And so I would love to go to Japan, but it's a different culture. It's, it's a little, US is a country where welcomes immigrants, not that difficult to get around here. I brought a friend from Costa Rica. His lifelong dream was to come to the United States, brought him to the United States. He was in San Antonio, spoke no Spanish, no English, had no trouble getting around. There's people everywhere. And then we went to New York City, had no trouble getting around. Everybody spoke Spanish in New York City. It's very easy. I think if I were to go overseas, into Asia, I've always wanted to visit Asia. I'd probably go to Singapore, because I think I could probably survive in Singapore speaking English. I'm probably not speaking Spanish. So, that's a big part of productivity is if your older workers are retiring or dying, you've got to get younger workers in. That's immigration. That's education. Who's got the best education system in the world? We'll talk about that when we talk about some international. Is it the US? We rank high on reading and science and math. So that's what you're looking for here is productivity. It's the key to the wealth of nations. It's the key to earnings growth, economic growth. So we're going to spend some time on this productivity question because it's really quite critical. But one thing you'll notice with productivity is how weak it has been. When President Obama left office, he wrote a letter to the economists talking about his greatest accomplishments and his greatest regrets. And he said his greatest regret was weakness in productivity. He thought, we've got to fix this. If you want that article, I can probably find it and send it to you. It's really, really interesting. But he wasn't blaming himself for it because it's a global phenomenon. He said, we got to fix productivity. He was talking about education, some other things. But yeah, we'll get into that here. It's a really fascinating topic. All right, we'll stop there.